So, Jay, you are the head of active ETFs and thematics at BlackRock. Can you just tell us a little bit about that role and what thematic investing means at BlackRock?
Yeah, absolutely. So I think a lot of people in the markets think a lot about the now, what's happening in today's economy, what's happening with interest rates, what's happening with investors. I focus a little bit more on the next. What is going to happen? What does the future look like? And which companies are really going to benefit from that? So at BlackRock, the way we think about thematic investing is really about identifying these long-term structural trends that are going to have really wide-reaching implications across the economy and society. The way we organize this is in our five megatrend pillars. So, yes, of course, technology is a big piece of this, but it's not just tech. We look at tech, we look at society and demographics, we look at urbanization, we look at emerging global wealth, and we look at climate change and resource scarcity. And so we have dozens of themes that really land in one of those five megatrends buckets that, again, are kind of those long term structural in nature and that we believe are going to be real drivers of returns of certain companies going forward.
Yeah, and there's a really, I think one thing that you can do for us, which will be really interesting for our audience, is maybe just differentiate between structural and cyclical themes and growth.
Absolutely. So structural themes tend to follow what I call an S-shaped pattern of adoption, meaning, it's something new that hasn't really happened yet, but you start to see kind of this slow incremental improvement in people adopting that technology or product or idea. So think about electric vehicles. The first commercially viable electric vehicle came out in the 1990s. It was slow, it was ugly, it had bad range, it was expensive. So only really kind of innovative people were buying this product. It took 20 years to get to the point where we started to see really mass market electric vehicles enter the space. But now that has happened and we've seen prices come down, you've seen a real acceleration in adoption. Yet, as we may talk about a little bit more, it's still early. There's still many more years of adoption ahead of us. At some point, electric vehicles will just be vehicles. They will fully replace the 80 million car market a year around the world. And then it kind of tapers off. That is the S-shaped pattern adoption: slow, fast, slow. Cyclical themes don't really follow that trend line. They tend to come and go much faster. They tend to be based off of shorter term fads or shorter term market developments. You can absolutely make a lot of money playing cyclical themes the right way, but they're very hard to identify and to really time because you're really trying to capture something like, let's say, a change of interest rates really quickly. So at BlackRock, we really encourage people to look at structural themes because we think if you can place less emphasis on timing and more emphasis on what's the power of the theme and really kind of outlasting the markets and taking that long-term view, that's where the most benefit is for investors.
Yeah, and it must be a super fun role because you're not in the nitty gritty of, let's say, day-to-day markets, which there's a lot of noise. You can take a step back, put your feet up and take a look at all the major themes that are going to really dominate for the next kind of couple of decades, which is, it's a pretty good job if you ask me.
It's fun, but it's also, I like to think of it as optimistic. We get to think about the future, and often these trends are positive developments, right? Technology enhancing our quality of living or creating a more productive society, social and demographic changes that are leading to new generations rising and new preferences. These are all exciting, optimistic things, and so I find it very fun when especially when the markets seem a little bit challenged and people are struggling to find opportunities. I like thinking 5 to 10 years out at all the amazing things that are happening around the world.
Yeah, absolutely. And I'm glad you brought up markets because thematic investing, I guess last year or maybe the year just prior, when rates were, let's say, near zero, obviously tech stocks were supported by valuations, and maybe some of these more optimistic or longer duration assets that maybe are generating cash flow further out into the future have, let's say, pulled back in 2022. There was a big reset. We're in a very different macro environment now. Rates have gone up 500 basis points, which means that we're at a different kind of point in, let's say, that cyclical kind of cycle, in the cyclical economic kind of environment. So how do thematic ETFs kind of fit in an investor's portfolio now in 2023?
So we really see people using thematic ETFs in two ways. The first is, recognizing these are concentrated portfolios. We are trying to get as pure play exposure as possible to these long-term structural themes. We cut across geography, we cut across sector and style, really just trying to find the companies that are most likely to benefit from the materialization of a theme like robotics or EVs or cybersecurity or infrastructure or whatever the theme may be. That creates a lot of concentration. It also creates a lot of tracking error, meaning our themes are not going to behave that closely to something like the S&P 500 or the MSCI All Country World Index. They're going to behave very differently because they're owning a very kind of narrow set of stocks. Uh, that's actually in many ways the benefit, that it's not looking exactly like what people already own, but also it's going to create kind of these wide ranges of outcomes. So for investors, the first way that they are using it in a portfolio is they build a core. They might have that S&P 500 exposure and some international exposure, maybe some bonds, but then they're creating a satellite portfolio where they're allocating a smaller amount of money and distributing it across 3, 4, maybe 5 themes. The key here is recognizing that satellite portfolio, again, is going to have that volatility. It's going to behave a little bit differently. And it's really an opportunity to kind of put your long-term money in that portfolio and wait for the theme to materialize. Another key to that portfolio is to make sure you have diversification. So as you were saying, tech stocks were hurt last year. A lot of themes are tech related, but not all of them are tech related. So making sure that you're not just kind of slicing and dicing different tech sectors, but looking at themes that play in infrastructure and healthcare and consumers and emerging markets, that helps create a more diversified thematic portfolio that can help people navigate the bumps along the way. But the second way that people are adding it to a portfolio is they are kind of, I would call it sector replacement, meaning if someone already just has a broad portfolio and they have tech sector exposure or healthcare sector exposure, they're selling that sector and instead buying a theme that plays within that sector. So instead of just owning all of healthcare, you kind of reduce that position and instead add to genomics or neuroscience or kind of really kind of more narrowly targeted growth areas within healthcare.
Yeah, and I'm so glad you kind of brought up styles, because I think when investors associate thematic theme, let's say themes, technology is obviously what they think of, because it's it's exponential and it's kind of development. But within that, there are some kind of value elements to it, right?
Absolutely. So, I think some of the most compelling themes are the ones that are kind of valued as value stocks, but actually have these really long term, powerful tailwinds behind them, because that means the market is just totally wrong on what the opportunity is. So, a good example of this last year, as tech was selling off, one of our most powerful themes, both from a performance perspective and from just an investor interest perspective and flows, was US infrastructure. These are industrials companies. These are utilities companies. They're not often considered these really high flying, exciting stocks. But what's happening? Our infrastructure in the US is really falling apart. It gets a C minus from the American Society of Engineers as a grade rating. And the US passed a $1 trillion infrastructure bill to really replace and repair infrastructure around the country. So suddenly you have this really kind of old physical world, kind of boring industry, frankly, that now has a $1.2 trillion tailwind behind it for real structural reasons. That's where a value oriented theme can suddenly really kind of accelerate its growth prospects. So that was, I think, a really good example of how thematic investing does not just mean technology. It can really happen in a lot of different sectors.
Yeah, that 1.2 is not a small amount of money at all. Big tailwind. Let's dig into maybe some actual themes that you're excited about. 2023, you've mentioned in some commentary, or BlackRock has mentioned in some commentary, as being a pretty significant year for electric vehicles and autonomous vehicles. We can differentiate between the two. Could you delve into some key developments that's driving this excitement around that space?
I think there's several things that are driving the excitement. The first is breadth of models. So there's about 40 plus models in the United States now of electric vehicles. That's great for investors when they show up to a car lot from different brands, if they're looking for an SUV or a sedan or a truck. Now there's really a full, kind of offering of electric vehicles, no matter what type of car or even price point that you're looking at. The second, though, and maybe more importantly, is price. We've seen the price wars in electric vehicles kick off in earnest this year. We've seen some very significant car companies slashing prices. That's because they are starting to achieve more scale. They understand how big this car market is. They know that they need to ramp up production of EVs, which is a totally different manufacturing process and supply chain than traditional vehicles. And they want to start winning the market share battles. So as prices come down, it makes it easier on consumers to look at, here's an internal combustion engine vehicle, here's an electric vehicle. The price is not that different, especially because of tax credits that are offered in the United States now, and they can choose the vehicle that is the best suited for them. But that really leans in favor of electric vehicles, which previously had been expensive, and previously, consumers were a little bit more lukewarm on. So that's an exciting development from a price perspective. And then I think the third thing is the infrastructure. Electric vehicles need to be charged. You can charge them at your house. You can charge them on the highway, at super stations, at superchargers. But as that gets built out, as we build more and more charging infrastructure, it makes it easier and easier to own electric vehicles. So we've seen massive gains in all three of those areas this year: breadth, price, and infrastructure. I think in particular, it's really going to benefit kind of mass market vehicles in the United States, where the average vehicle here is sold for $50,000. There's over 10 electric vehicle models that you can now get for under 50,000. So that means there's really an offering that is intended for the mass market. It's not just a premium vehicle anymore.
Yeah, price is certainly the biggest factor, I guess, for most consumers when they're thinking of electric vehicles. But it's also around the infrastructure, right? It's the charging points. It's a big concern, obviously, is the range of these vehicles. So what does the investment, let's say the Inflation Reduction Act and other infrastructure bills that have been passed, how do you see, or what do you project for, let's say, the number of charging stations over the next by 2030, for example? And is that keeping pace with what you expected? And how critical is that to mass adoption?
So it's a huge ramp up across the ecosystem. I think first you just have to look at the raw materials, the lithium, the copper that go into building batteries. We've seen a lot of investment in the last few years to expand that output. The second piece is the actual manufacturing. So the Inflation Reduction Act is giving tax credits to auto manufacturers to build electric vehicles in the United States. This is not easy. They have to completely retool factories, open new factories, train workers on how to build these vehicles. But by giving those tax credits, it really accelerates that transition. So we've seen billions of dollars committed by some of the largest auto manufacturers in the world to open or retool plants to really be focused on EVs going forward. So I think that's a really exciting development. On the charging infrastructure space, we're seeing a massive, massive commitment, not from the Inflation Reduction Act, but from that $1.2 trillion Infrastructure Act, the IIJA. That's bringing hundreds of thousands of new chargers to the United States. And maybe that doesn't sound like the most exciting thing in the world, more chargers, but if you really think about it, the higher density of chargers ends up being a subsidy for car buyers because, one, it'll create more supply, which should reduce costs. But secondly, you don't need a 400-mile battery if you can charge all over, your town or the highways that you drive on. So you can actually reduce the cost of the car significantly if you know that there's fast charging available all over.
Yeah, absolutely. And transitioning now to autonomous vehicles, which is a different thing, but let's say a leading US manufacturer like Tesla obviously is an electric vehicle, but is working on autonomous vehicle technology. Could you maybe unpack what does that actually mean? Because obviously people think autonomous, oh yeah, just hands back. I just sleep when I'm driving and things like that. What are some of the why haven't we got there yet? And what are some of the major drivers of why this is such a big market?
So it turns out it's really about the edge cases that make autonomous vehicles really hard to perfect. From a mileage perspective, a lot of car manufacturers have software now which can, keep you on the highway, keep you moving at the right speed, keep you in your lane, slow down when traffic slows down, speed up. That's great for covering, 90% plus of miles that you might actually drive. Where autonomous vehicles have struggled is, what do you do on an unprotected left-hand turn? What do you do, when there's a large stream of pedestrians and you have to kind of creep out into the middle of the road to make your turn? What do you do if a delivery van is double parked and you have to, kind of ease around it and kind of drive on the other side of the road temporarily? So those are easy things for humans to do. We do it all the time. It's not the easiest thing for a computer to do. So a lot of the training and a lot of the advancements in autonomous vehicles just in the last year or two have really been around those edge cases. Now, because this is an incredibly new way to drive that requires a lot of trust from society, it's not enough for autonomous vehicles to be as good as humans. It has to be much better than humans for people to really depend and rely on this technology going forward. So I think we're still we're getting closer and closer from a technology perspective. But I think in a lot of ways, society is still lagging a little bit behind because people still want to see that this is a perfect technology that's never going to get into any issues, and I don't blame them. This is how consumer preferences work and how you disrupt 100-plus-year-old industry of driving. But it's going to take some time. I would say, electric vehicles as a theme is much more advanced right now than autonomous vehicles, which is still in the very early stages of adoption.
Yeah, absolutely. But the two are linked, aren't they? Because like we've seen with Elon Musk and Tesla cutting prices, and as many other manufacturers are, there's a kind of I guess 3D chess move that we can like interpret from that is, let me cut the cost of cars to get more automobiles out there, and I'll be able to basically upsell software as a service to all these cars driving around. So what's your kind of take on that? Are electric vehicle manufacturers cutting costs just to get more vehicles out there? Or is it a kind of price sensitivity, weak economy, consumer demand low or lower, driving that? Or is it a bit of both?
So there's really two major reasons why car manufacturers are starting these EV price wars. The first is scale. Every car manufacturer right now that is investing heavily into electric vehicles wants to produce at higher scale. It'll bring costs down. They can get more competitive. They can start making money on electric vehicles. So that's not easy if you're selling thousands of cars a year. That is easier when you're selling hundreds of thousands of cars a year. So cut price increases consumer demand. You achieve scale. You can be more profitable in the future. But the second reason is exactly what you said. This is the video game model or even the smartphone model of get people in relatively cheap into the platform and then sell them a lot of goods and services along the way. Sell your video game console at cost, but make sure people are buying, 4 or 5 games a year and all the accessories. That's what we are starting to see in the electric vehicle space too. Get people in the car, but then you can sell them navigation, you can sell them autonomous vehicles, you can sell them charging, you can sell them all kinds of different subscriptions. And software as a service is a very scalable, very profitable area once you get people subscribed to it. So I think it's an incredibly different business model for the car industry. It's one that is going to take some time for some legacy auto manufacturers to get comfortable with because you might be really good at building cars and not so good at building software. But it is the direction of travel over the next 5 to 10 years. Absolutely.
Yeah, and kind of within this EV AV theme, how do we actually play this? How do we trade this as investors? Obviously, we can buy kind of broader exposure to ETFs, but I want to kind of go under the obvious names, let's say like a Tesla or someone like this. Within the kind of that space, how else can we play the sub themes within this sector? So I'm thinking like inputs, raw materials, kind of software as a service. How do we play this as investors?
So I think you bring up a really good point, which is it's easy for investors to probably name the 1, 2, or 3 biggest EV car manufacturers. These are consumer brands, they're well known, they're a large market cap. They're really important to the ecosystem, but there is a whole lot more companies out there that are going to benefit if EVs really take over as the new transportation technology. So where we like to look is at the most upstream stage is who's producing the key materials like lithium that go into batteries. We look at the battery manufacturers, which are often but not always separate from the car manufacturers who can really build batteries at scale effectively. The car manufacturing side, of course, plays a big role. But then you also look at parts suppliers. Cars are more assembled than built when it gets to the auto manufacturing stage. So who are the companies that are building electric motors, that are building assembly systems, other sensors and chips that go into electric vehicles? Those are really important components. And then finally, looking at the charging infrastructure, the companies that are investing really heavily right now in kind of building this ecosystem so that you can drive your car, ideally kind of anywhere around the world and always find a charger. So when you add that all together, you have dozens of companies. It's not just the two or three, most famous car manufacturers, but really dozens of companies across the ecosystem that we see benefiting from the rise of EVs.
I'm pretty sure we could speak about this theme for another 3 hours, but we have to move on to another big theme, which is all anyone can ever talk about, right? In 2023, I think if you watched Google's developer conference last week, I think Sundar Pichai said AI like 50,000 times, but it's generative AI, of course. ChatGPT, fastest consumer-facing app to 100 million users. I think it was like a couple of days or whatever it was. Generative AI is the complete buzzword right now. How does BlackRock think about generative AI as a kind of as a theme and as an investment, and which kind of areas does BlackRock see as ripe for disruption in that kind of AI space?
So we've been looking at AI in the context of both AI and robotics for several years now. Robotics is really, the technology-driven body. AI is the technology-driven mind. And the two often go hand in hand, but also can kind of move at different paces and expand into different areas. So, if you look at maybe kind of the 2018 to 2020 range, a lot of advancements were made in robotics, specifically in industrial warehousing. You think about, distribution center for e-commerce. They're trying to automate as much of those processes as possible to bring costs down and make it more efficient. That's been the story for the last few years. This year, and maybe starting in December of last year, you saw the pendulum really shift to AI. Yes, that had to do with ChatGPT coming out. Yes, it had to do with all the competitors coming out and kind of introducing their own generative AI models. But the pendulum has shifted. And I think what surprised people here was the original view was that AI and robotics was really going to start to do kind of lower value tasks. Maybe it's kind of more manual tasks, moving things around warehouses, working kind of in factories. It turns out that AI is actually much more powerful right now in knowledge-based tasks, and that's what I think really shocked the world with generative AI. Of wow, this is a really powerful tool to do things that, in a lot of ways, replicate some of the things that I do on a daily basis. So, in terms of who benefits from this, we want to continue to look at the broad ecosystem across robotics and AI. I think we're still scratching the surface of generative AI and what the use cases are. So, we don't want to limit ourselves too much with just a couple narrow winners. So, we look really at four areas. The first is who are the AI developers? A lot of these are some of the big tech names that own the most data, that have the most processing power, that have the most talented computer programmers. They are, by and large, building the greatest AI models that are out there. But the second layer underneath that is what we're calling the AI enablers. These are the companies that are allowing, these generative AI platforms to run, and often means semiconductor companies. It took about 10,000 GPUs, 3 months of training to train the original, ChatGPT or GPT 3.5 language model. That's a lot of processing power, and that's for one version of one company's AI offering. You think about all the different competitors around the world that are trying to build their own generative AI platforms, and you can suddenly see there's immense demand for powerful semiconductors. So we don't just want to look at the companies that are building AI, but the companies that are going to benefit from the proliferation of AI. The second half of it is on the robotics side, and it kind of mirrors AI. We look at the developers of robotics, more of the industrial manufacturing companies, and we look at the enablers of robotics, a lot of those inputs that allow robots to be as powerful and dexterous as they are today. So that's the entire ecosystem. It's over 100 companies. It's a lot of companies around the world. Particularly, this is a international theme that has a lot of leadership outside the United States and cuts across a lot of different sectors, because AI and robotics right now is probably one of our most promising themes in terms of how big the total addressable market could be.
Yeah, I think really well said. I think what surprised people is just the exponential nature of it, right? It's just moving at such a pace. And I actually just wanted to get your take on this, or maybe to shed some light on this, because all these themes that you're looking at kind of have a common characteristic, in the sense of they are in a lot of cases exponential. If you think about, I know I've seen you write about it, is the cost of sequencing a genome, right, has gone from hundreds of thousands or millions to hundreds or thousands of dollars. And it's all about reducing that kind of cost curve down, which is kind of mapping across the electric vehicles as well. It's all about that scale and that kind of driving costs down, and it's going to become more readily available. So could you speak to that, and what you see from where you sit on some of the things I've just mentioned?
Well, there's a lot of opportunities for exponential growth in robotics and AI. I mean, the first is, how much data is being produced in the world. Data is essentially the oil into the engine of AI. So the more data we have, the more powerful AI is going to get, all else equal. I think the second area is the exponential advancements we've seen in semiconductors. Moore's law has continued to get, more and more powerful, cheaper semiconductors, which, that's the engine that oil runs on. And then finally, it's really kind of how this technology is evolving. How as it gets smarter and more powerful, you're starting to see these language models kind of rapidly iterate and get more and more powerful, seemingly kind of month by month. So there's absolutely exponential opportunities across that technology. And what's mirroring that right now, but sort of at a lag, is the use cases. And what I mean by that is like this technology gets better and better. People are still figuring out what to do with it. Can this be used in the legal field? Can this be used in programming? Can it be used for consulting? Can it be used for travel booking? There's all these different use cases that generative AI might be able to be used for that people are trying to figure out and test and get their companies comfortable with going forward. So it's still exponential, but it's a little bit with a lag. Every time the technology gets better, it takes humans a little bit to catch up and figure out what do we do with this technology, which is just continuing to accelerate.
And with your kind of product hat on, what other kind of areas or big themes do you see out there? And I think it's very applicable to generative AI and this whole like explosion of interest. Is how do you separate the signals from the noise when you're thinking with that innovation hat on?
By and large, our themes should be relatively self-explanatory. What we're trying to do is find high conviction and high probability ideas in an uncertain world. So what I mean by that is, it's very hard to predict what's going to happen with the markets in the next month or year. Hard to predict what the Fed might do. Hard to predict, what sector is going to outperform another sector. But if we look at the long term, we believe with a lot of conviction that these themes are likely to play out. They're likely to really kind of address their total addressable market, and that we should see, really powerful growth for the companies that benefit from those themes. So oftentimes that means we're not trying to pick some theme that no one's ever heard of. Oftentimes these are well-known themes, well-known technologies, well-known trends. But what we're doing with the product hat on is one, getting really good exposure to it. So we're really trying to separate the true winners from the theme from kind of more tangential winners. And the second thing is we're trying to really educate investors on what the opportunity is with thematic investing, which is identifying the theme early and having the patience to see it really play out. The markets are really short term. People don't own stocks very long these days. I think the average holding period is in the realm of months now. Companies pay their executives based on 3 or 4 year vesting plans, which means that companies are often focused on how are we going to make money in 3 years, not in 10 years. Analysts are encouraging quarterly returns or kind of quarterly earnings, which again is kind of creating this short termism in the market. We think the advantage that investors can have if everyone's playing the shorter term game is to really zoom out and look at the long term game that is really kind of underpriced by the markets. So again, we're not trying to find the themes that people don't believe in. We're trying to find kind of these really high probability themes, but we're encouraging people to own them for the long term because that's where the alpha opportunity is.
Absolutely. And for the listeners that should be, let's say, thinking long term, we've talked about AI, we've talked about electric vehicles, we've talked about autonomous vehicles, and we've also mentioned some regulatory tailwinds for different other kind of sectors. What other spaces are you super excited about, and what retail investors should be looking at for, let's say, the long term?
So one area we haven't spoken about yet that I'm pretty excited about is in the medical field. The pandemic, in a lot of ways, accelerated a lot of medical innovation. If you look at mRNA-based vaccines, that's a pretty obvious example where mRNA technology had been around and been researched for a couple of decades, but didn't have a lot of funding, and frankly, regulators were not very eager to approve of this technology in medicine. That all changed with the pandemic. It was, really the best way to rapidly create a new vaccine. The FDA got comfortable with it. There was tons of money pouring into the mRNA-based vaccine space. And now what you're seeing is all of these, researchers and pharmaceuticals companies are looking at this technology and saying, how else can we use it? It's like the semiconductor was just invented, and people are like, how do we use this thing? Is it, should we use it in computers? Should we use it in cars? That's where we are with mRNA. So people are researching it to potentially create skin cancer vaccines, to address multiple sclerosis, to address HIV. All of these, horrible diseases that have been around for a very long time that we haven't really cracked from, a treatment or vaccination perspective. Suddenly, that's on the table. And that is, from the beginning of the podcast, I was talking about, like, I like to think about the optimism in thematic investing. This is probably one of the most optimistic areas, that these medical breakthroughs are really set to harness this new technology and this new regulatory environment to address diseases that have been with us for far too long. So I think this creates incredible opportunities in genomic stocks, in neuroscience stocks, in biotechnology more broadly. If the last decade was really kind of about mobility and telecommunications, I think this decade is going to be about medical breakthroughs.
That's really, really exciting. And just as a kind of follow up, I guess, to link the two themes together is, could generative AI, well, will it really put rocket fuel behind this kind of medical field, because it's obviously able to create tons more data for the models to be trained on and for predictive stuff? What's your take on that?
I think there's a few different ways that generative AI could play into the space. So, one is just in diagnosis. If you can put in, a patient's or your own symptoms and test results, generative AI can pretty quickly scan all of the medical knowledge that it has absorbed through public data and spit out, here are the 5 possible diseases or ailments that you might have. That can save a lot of time for doctors. Maybe that gives us kind of more leverage with doctors, where we don't, need as many in the future. It can reduce costs potentially of healthcare if it uses less doctors' time to make a diagnosis. So I think that's incredibly powerful. Maybe outside of the generative AI world, but in AI more broadly, you are seeing it being applied to drug discovery. So we have all of this medical data. We're getting more and more medical data from all of the genetic testing that we're doing. How can you use AI to sort through that data, find commonalities, find opportunities for new technologies and new potential drug compounds? I think that's where the really exciting opportunity is for AI in kind of that medical breakthrough space.
Yeah, I saw a brilliant example of this guy took this dog to the vet, and the vet couldn't cure the dog or diagnose the dog, but then he got the lab results, and then he put it through to ChatGPT and said, oh, the vet said it wasn't this disease, could you suggest some other, basically potential diseases? And they put the blood work and all the medical kind of data in, and it was able to diagnose this dog, and it saved its life. So it's pretty cool application. So if you ramp that up to humans and populations, it could be super powerful, right?
I don't know if you can hear him, but my dog's barking in the background. I think he agrees with you that I'm very excited about the veterinary opportunities in generative AI as well.
Yeah, I could hear it. That's why I brought up the example. Perfect. Well, Jay, it's been a pleasure to get your thoughts, and we'll have to do this again in 6 months when ChatGPT 10's out. Where can people find your work or follow you after this pod?
Yeah, I'd really encourage people to go to iShares.com/insights or iShares.com/megatrends. That's where you can find the latest information and research on all of these themes. We are kind of constantly putting out new insights as these themes evolve very quickly. So encourage readers or listeners to go there.
Brilliant. Well, thank you so much. And see you next time.